actually like really useful. You know, they carry out multiple functions. Muting the volatility, you have ammo to buy any dips or great opportunities that come up on days where everybody's in Wojak mode. And also you can make income on them, which is fantastic. So you've got the directional play, you've got the stablecoin play, and then the third component, in my opinion, of a proper DeFi portfolio is the income plays. For me, that's something like Curve. Now, I think Curve is one of the least well understood things in DeFi. And I'm sure if you guys are on crypto Twitter, which you obviously are because, hey, you're here, you've heard about the Curve wars and Tetranode, cornering the convex supply and all these DeFi DAOs, fighting to get convex. And you may have asked yourself, what the fuck are these guys doing? Like, why do they want this convex token so bad? Why does everybody care about Curve so much, right? So a little history on Curve. Curve is actually, or it was, a stable swap, and it's just an AMM. So in DeFi in general, there's like, I'd say, two main components to DeFi, and we're just talking like basic components of a financial market. You've got exchanges, which in DeFi are AMMs. What's an AMM? Well, it stands for Automated Market Maker. And look, guys, you might be listening to me right now and saying like, dude, come on, like I know that, but this is the For Dummies episode. Like there's no judgment here, and I'm sure we're going to get some interesting questions later, so just bear with me. The most popular AMM is Uniswap. And I'm sure you guys remember, if you were here then, back in early 2020, mid 2020, Uniswap's rise to popularity. Now, the kind of market maker Uniswap is it's called a constant sum market maker. And the core of this market, or of this exchange, right, is this liquidity, these liquidity pools that people are able to tap into. Now, we'll get into impermanent loss and all that stuff later if we have time. But let's say I have some WBTC and I have some ETH, right? So I can go to Uniswap, and this is like we had these central limit order book exchanges on Ethereum for a long time. But the problem was that when you're sourcing liquidity from the community, and you're looking at an order book. Now, what are you talking about? What's a club? Look at like Binance, look at FTX. They've got like a bid and an ask, and there's different depths, right? And there's market makers that actually are providing liquidity on both sides. Now, theoretically, these market makers are considered to be delta neutral, which just means that they don't really care about the direction of the market. They're going to adjust their ratios and move their bids and asks around. Really, the only thing they're trying to do is kind of play a game of ping pong. They want to make money on that spread, the difference between the bid and the ask, wherever they're getting filled. So on an AMM, and this was a huge revolution in DeFi. I mean, this is pretty much what kick-started DeFi, in my opinion, in a huge way. The revolution with an AMM was that anybody can be a liquidity provider. Because if you think about, hey, I want to be a market maker, and you're just on a central limit order book exchange, there's a lot of thought that goes into that. There's automation, there's algorithms, there's, and even with that, like your shit has to be fine-tuned or you're not going to make any money, right? You might end up losing a lot of money. You might end up losing money on Uniswap. In fact, I think a lot of people do. But the innovation here was that in the past, where let's say I launched a new project and, hey, I really need to get listed on Binance, and I need to get a professional market maker so people have that liquidity to buy and sell my project, because liquidity is very important for a project. Now anybody can just come and establish one of these liquidity pools on Uniswap or somewhere else, Sushi, there's tons of them. And that liquidity, for my project can be immediately available, and everything is just algorithmically managed. Now, what these pools actually do is they maintain a 50-50 ratio of each asset in the pool. So there's always going to be equal parts dollar-wise of Bitcoin and of Ethereum. So another component of DeFi is oracles, okay? So a lot of people have been like, what the fuck is Chainlink? What does Chainlink even do? And I know Chainlink's kind of been a meme recently, although, it was God for a long time, just because it's underperformed everything else. But Chainlink provides one of the most important services in DeFi, and that is making sure that these smart contracts have accurate data that they can make these minor adjustments with. And without this data, without these Oracle services, and Chainlink's not the only one, it's just the most well-integrated, well-known one, none of DeFi can function properly. None of DeFi can even work. So I think noobs really, really like the idea of an AMM because, when I go to an exchange, it just simplifies things. There's a buy button and there's a sell button. And I know immediately how much I'm going to slip the price. I know how much I'm going to get. I don't have to worry about setting a limit order and waiting for it to fill or anything like that, although, that functionality is available in DeFi. It just made it so anybody can be a liquidity provider. And what happened as a byproduct of that is all of a sudden we have all sorts of liquidity, big liquidity for all of these great projects. And a lot of this liquidity isn't professional market makers. It's provided by the community. So DeFi is all about the community. DeFi is about banking yourself, being your own bank, having, participating in this fair, open, decentralized financial system. So I think that speaks well to that. Now, the second major thing in DeFi is going to be these lending and borrowing markets. Probably the most famous of which is AAVE. Another one I'm sure you guys have heard of is Compound. But what that actually allows you to do is, let's say I have a bunch of Ethereum, right? And I'm like, hey, I really don't want to sell my Ethereum, but I need some cash for whatever reason. Maybe I need to pay my bills. Maybe I'm interested in buying something else. Maybe I want to yield farm with the cash. What I can actually do is then go to AAVE and then supply, right, my Ethereum as collateral, and then I can take out an over-collateralized loan against it. Now, that's actually a huge innovation because, in the past, when anybody wanted a loan against any kind of assets, what the fuck are you going to do? You're going to go to the bank. They're going to pretty much strip search you like what happens at an airport. They're going to inspect your anal cavity. It's just really intrusive, and the likelihoods of you getting a loan, especially as a crypto guy, right? If anybody here has ever been through that experience, I have, are extremely low. They're going to tell you you're not shit and, to get the fuck out of there. They don't want to deal with you. And you might even say, yeah, go ahead, RT.
No, they suck. I just went through this trying to get a house. You could show them anything you want, but if it's not an income statement and it's not all this and it's not all that, especially as crypto guys, it doesn't count for shit. And,
have you seen my Zapper balance? So what? Let me see your W-2. Let me see your asset balances.
Hey, look, fair enough. That's their model. They have a model. Yeah. It's like insurance. It's just an algo, and fuck them. Fuck the banks. We don't need them, and that's why I'm excited about DeFi. You can take some assets that they don't care about and just borrow against them from wherever. There's lots of options right now.
So the over-collateralized loan is how DeFi lending works right now. And there are other models like Maple Finance and stuff, but we're not going to really try to get into many specific projects other than just for examples today. But there are other models that are being developed in DeFi, but right now, over-collateralization is how all this works. And what over-collateralization does is it actually protects the people that are lending their assets. Because theoretically, let's say, I come, I've got $1 million worth of Ethereum, and I decide that I'm going to borrow $700,000 against it, right? Well, what the fuck happens to the lender? If I come and I borrow their $700,000 or whatever, what happens to them when I can't repay the loan? So that's where the over collateralization comes in, because I'm not able to borrow against all of my collateral, right? I'm only able to borrow against a percentage of it, and that gives some cushion as the market volatility plays out. That gives a little bit of cushion, a little bit of comfort to the lender. But if I get down to a certain threshold to where the amount I borrowed, right, starts becoming, starts getting close to the value of the collateral that I put up, You've heard about people getting liquidated, and that's what happens because there's certain ratios and certain like health factors that people have to maintain.
You have to protect the lenders, or it'll collapse, right? And banks protect that with credit scores and convoluted things. And are you able to pay it back? And there's a ton of bad debt out there. But in this case, that the over collateral, that's just,
and there's a necessary evil. DeFi too. And that's a topic for another day. But the debt is managed in that way because now what they can do is, rather than me not being able to pay that lender back, now what they can do is they can say, hey man, like you put up collateral in this smart contract, you're running into a situation where you're not going to be able to pay the lender back. So we are going to seize that collateral now, and we're going to make the lender whole. That was the agreement that you entered in. So one of the biggest issues with things like AAVE and AAVE v3 addresses this is cross collateralization. Basically, the entire system is collateralized by the entire system, I think is maybe not totally accurate, but maybe the best way of looking at it. And all that means is that, if there's a hole somewhere in the system, that the entire system can be impacted by it. And that's why you have these new kind of DeFi 2.0 protocols like Abracadabra.money that have introduced isolated lending markets. And all this means is that, each market is kind of its own market. It's not collateralized by multiple things. The system isn't propped up by multiple things. It just kind of simplifies everything and reduces risk for everyone. So, we've talked about kind of ideal DeFi portfolio construction, what DeFi basically is. You've got exchanges and then you've got borrowing and lending, and, it goes beyond that, but that's just the most simple aspects of DeFi. Now, the third thing about DeFi that I think we can talk about really quick, and then we can open up the floor to some discussion and Q&A, which is why I know you guys are really here, is yield farming. I'm sure everybody here has heard about farming. And, for a DeFi guy that's been around for a while, farming is kind of second nature. I know what it is. But if I was new to the space, or I was just on Twitter and I was seeing people posting these humble farmer memes and shit, I'd be like, man, like, what the fuck are you guys even talking about? Like what does that even mean? Okay. Now, there's certain ways to earn a return on whatever you have in DeFi, right? At the core of all of this, we can go back to just the basics of, hey, I am going to supply liquidity on Uniswap, right? Well, as people access my liquidity, if I'm pairing ETH versus WBTC, and somebody has some ETH and they want some WBTC, well, guess what? They can tap into that liquidity I provided. They pay a fee for that service to tap into my liquidity, and that fee goes to that LP position. Now, in DeFi, when I deposit my Ethereum and my WBTC to Uniswap, I get a receipt of that deposit. That's called an LP token. Look, it just means liquidity provider token, okay? So I put 2 tokens into the pool, I get 1 token out as a receipt of that. And that LP token has a value too, and that value is represented by, the assets in that container, if you will. Now, that's also called an interest-bearing asset, okay? And that's another concept in DeFi that's kind of talked about a lot. That just means that this asset over time is accumulating other assets or accruing value in some shape or form. Now, you kind of get the same thing, if I were to go deposit on AAVE, for example, and I deposited my ETH there, I would get a ETH back or something like that. Now, DeFi is all about composability, protocols being able to interact with each other, capital efficiency, being able to use my money in multiple ways in multiple places. So the most basic form of yield farming is incentivized liquidity provision. And all that these projects are doing and all that these farmers are doing is these projects are saying, hey, I am willing to give you my tokens in exchange for you providing liquidity on Uniswap, for example. And what you're going to actually do then is you say, okay, Well, I've deposited into that Uniswap pool, but how do they fucking know that you're carrying out your end of the deal? How do they get those tokens to you? Well, now I've got this LP token, right? It's a receipt. And just like any other ERC20 token, I can send it to wherever I want. So what I'm going to do now is they're going to have a farm on their website. And I go and I'm going to stake that LP token with them. So I take this LP token, which is basically just a receipt of my deposit in Uniswap, right? And then I'm going to deposit this LP token into the farm. And in return for that, me proving that I'm carrying out this service that they've requested, I will start to accumulate in a separate contract, really, tokens in whatever shitcoin is paying me for liquidity, right? And that's just kind of basic yield farming. That's basically how it works. Now, there's also things like Curve, which, I'm sure you guys have heard of gauges. What the fuck is a gauge? Well, gauge is really just a yield farm, okay? So if I was to come into Curve and I was to say, hey, yeah, I've got $1 million, I'm going to provide some liquidity, I can go to 3Curve or 3Pool, depending on who you ask, and I can deposit my $1 million into that. I get that LP token back, and then I can stake that LP token into a gauge. So not only am I earning interest natively on that LP token, right, because people are accessing my liquidity, that service I provided, but Curve is also going to pay me for having that liquidity there. So I deposit it into the gauge, and in return for that, I start accumulating and accruing Curve rewards. That is, once again, that is yield farming at its most basic level. And for anybody that does have questions, because we are about to open the floor up, you're free to ask questions for me or RT specifically, or just questions, to anyone. But one thing I want to emphasize here, before we open it up, you are going to be recorded if you do ask a question. So keep that in mind. If you don't want to be recorded, please don't ask a question. And also, please be respectful of everyone's time. We don't want anybody to say, my question is 4 questions, actually. These questions are blah, 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 blah. Like, we want to try to get to as many questions as possible. Also, please try to keep your questions as noob friendly as possible, just so we can try to kind of help beginners out here, and kind of onboard them into DeFi. Now, on future episodes of Frog Radio, I'm sure we'll talk about strategies a little more, what we're doing, those kinds of things. But maybe that's what your question is. But for this one, I'd like to keep it as much of like the basic level shit as possible.
101. Yeah.
Yeah. Ask a question. We'll try to answer your question, blah, blah, blah. But we're going to open to the floor now. We've got a bunch of things requested, or a bunch of people requesting to speak. So I'm going to go ahead and get you invited up here. Bear with me. Give me just a second.
Yeah. And while Messiah is setting that up, just going back to, how to allocate a portfolio, what I've been learning about this month is allocating within my yield farming, right? So I've got it into 3 categories: stablecoin yields, where the base is just pure stablecoins. The yields are small, but the base is mighty. It's very not volatile, so it's my safer yield. That's where most of my yielding assets are. And then LP positions, where it's paired with a USDT or a USDC or a MIM. So it's slightly muted, but you're getting a better yield. And then my what I call volatile yields, where the underlying is just straight single asset or 2 volatile assets, and the yields are usually the highest, but you can assume the underlying will get farmed down to shit. And that's where I put my least amount. So also something to consider within DeFi and your yielding is sort of how to allocate kind of, I guess you could say, bottom heavy. So the lower, safer yields I do most of, and then, same with how you might allocate a portfolio with altcoins and all that stuff. So that's my last thought to share. Let's get to the questions. I see NBTB. Come on up.
Hey, just a quick question. I don't even know if this exists at this duration, but if you just want to leave money in stables and the institutional grade stuff for a few years, where would you do it? Or does it need to be faster rotations?
I mean, me personally, so I do all DeFi, right? I don't trust, I trust me with my money, and I barely trust myself, right? I'm definitely not going to be trusting, I don't even know what the fuck they're called. Celsius.
CeFi.
DeFi, yeah.
DeFi, centralized. And I'll give an alternate opinion after you're done, because I do a bit of that.
For me, okay, because there's a lot of rugs in DeFi, right? That's kind of something that not a lot of people talk about. So when we're talking about parking something somewhere long term, you really want to go with something that has a bit of lendy. You want to go with something that's been battle tested. Well, how do you know something's not a rug? Well, the thing is you don't. When there is money at stake in something, that's kind of like a standing bug bounty, right, for these hackers. And these hackers are going to do everything they can to try to get that money and to try to take that money. So for me, a good litmus test of, is this safe for me to park my money in long term, is how much money has been at risk in this protocol and for how long. How serious is this protocol? How battle tested is this protocol? In terms of stablecoins, I don't think that there's a better place to put them than Curve. Curve has been around for a really long time. It's an extremely well respected team. They really test their shit. They really know their shit. And look, there's been a lot of money at stake in Curve for a very, very long time. So if we're talking pure stables, that's where I'd put my money. But with that being said, knock on wood here, right? I mean, Curve could get hacked tomorrow. That's the thing about these things. You just never know. It's all a game of balancing risk and probabilities as well.
Yeah. And going back to CeFi, look, centralized entity can get hit up as well. They can get shut down. One of my favorite ones, Nexo, recently just got hit up by, New York Attorney General. They're basically saying, stop doing what you're doing. And Nexo is one that I kept an eye on since 2019. Now, that is where I have some of my stablecoin base parked. It's paying about 8% right now. It's boring. It's safe, quote unquote. But like any centralized entity, that New York Attorney General thing didn't feel great for me while I have some money parked in there. But I also feel like they're Eastern European, so what does New York have to say anyways? At the very worst, they just kick out US, which I'm not. So I have some there. FTX Lend as well, although those are very, very variable rates, and right now they're down at 5 and 3%, so they're not as fun, but a little bit there. So those are my two sort of base things. Other than that, Curve for stables, I agree there. Is also
and look, Curve is on Ethereum, right? But it's also a lot of other places. So we're definitely opportunity maximalists.
I like it on AVAX. Yeah, I only use.
We like AVAX a lot, of course. But the thing is, and I'm looking at this right now. Let's see. Give me just a second. Let's see. Go to the pools. I gotta switch my network so it recognizes. Let's see. Just bear with me. I'm going to tell you exactly how much yield you can get. And look, in DeFi, we've all been conditioned. If it's not a million gazillion percent APY, right? Fuck that. I'm not going to do that. But here's the thing, and here's a good way to look at something. If you are getting a million gazillion percent APY on something, I'd say that these higher interest rates are because of the amount of risk associated, with coming to capture them. Especially if somebody's giving you 1,000,000% APY in stables, you got to look at that wait a fucking minute.
Well, or you're just getting yield in the underlying, right? And I mean, a good example would be Blizz. I know both of us have some Blizz, and even just in the last 3 weeks, my yield has been knocked down as Blizz fell from $2 down to 30 cents or whatever, right? So that thing's just going to get rinsed. And I knew that when I locked up my Blizz. I was just by the time this unlocks, it will be worth half a penny because of the rate of the yield. But again, 4% of my yield farming is into that. And, I'd say 60% is just in boring old stables. So it comes into balance.
If you're not some kind of Ethereum, giga whale, right? And you do want to be gas conscious about that. I'm looking at the AAVE 3 pool on Curve on Avalanche right now. And you can go look yourself at AVAX, AVAX.curve, CURVE.fi/pools. And if you participate in this pool, you're going to earn basically 2 forms of yield, right? You're going to earn yield just for providing that liquidity, for providing those stable coins to the pool. And that yield is variable, okay? It fluctuates depending on the utilization of the pool, how many people are trading in and out of it. And then in addition to that, you're going to get paid some WAVAX, that's just wrapped AVAX. and also some curve. So I'm looking at it right now. I think this yield typically will fluctuate total, when everything's considered, between 10 and 15%. And considering that if you put, if you had 100 grand and you put that in a bank account, the fuck are they going to give you, like 5 cents a year for that? Like that's pretty legit. Like, I can just park my stables here. I don't know how long it lasts, but
I just tweeted a picture of the pool you're talking about, just in case anyone wants to see a visual.
I like this pool as a really good balance between, like, the yield is pretty good, and also the amount of risk that I'm taking. Like, even though this isn't Curve on Ethereum, it's Curve on Avalanche. Curve has been around for a long time with a lot of money on it. It's had every opportunity, to get exploited, for people to come take this money. It doesn't mean that it can't happen. But for me, it feels pretty safe, at least in my own assessment of that. Now, another concept.
That's decent yield. That's
it's
like
good.
13% after the incentive rewards from AVAX. Yeah, I should look at that.
That's really good.
More than my CFI yields. Damn.
Yeah, that's really good. Now, look, let's say you've totally cashed out. You're 100% in stables, right? One concept, and I don't know if you guys are Harry Potter fans. I grew up on that shit. But remember, Voldemort had a Horcrux, and what he actually did was he Horcruxed his soul, so that if you destroyed one piece of him, there's still all these other pieces of him that exist everywhere else. Now, one thing you've got to remember with DeFi, right, is that a lot of times all of these DeFi protocols are kind of composed with each other, and they're built on top of each other. So I might be depositing to some farm somewhere in my stables, but this farm is actually taking my money and depositing it somewhere else and giving me a little bit more of their token as a reward. A good example of this is Convex. And I know when we had Spot a Boom of Badger on, he was kind of discussing this layering of risk, right? Every layer of risk you add makes these things more risky. So when you're Horcruxing your stable stack, let's say you cashed out, you got $1 million. You're like, all right, I kind of made it. I'm gonna, just yield farm. I'm gonna make a bit of salary. Like, this is gonna be great. You really want to take that and you want to spread it out to, not 1,000 different farms, but you want it in 3 or 4 different places. If one of them gets knocked out, it doesn't take you out of the game. It hurts, but you're not wrecked. You're not done for. So that's another piece of advice. And also, just make sure that when you are Horcruxing your stable stack, or whatever you're farming with, make sure that you're not Horcruxing it into a bunch of things that are just depositing it into that same base layer as well.
That's a good point.
Yeah. That's where I was going.
That is not 101, but I like that, and I need to start thinking about that too.
But does that answer your question?
Yeah, that's a great rundown. Thanks, guys.
Okay, cheers. Thanks, bro.
All right, let's get Zubulon.
Oh, thanks. Yeah, I appreciate it. Zebulon.
Zebulon. Oh, man, that was close.
Oh, no worries. Yeah, I don't know. This might be too advanced or whatnot, but how, when you're looking at like a new project that you're interested in, that you come across, like how do you decide whether to do spot or farming? Like, I feel like I always end up, just investing in spot and just hoping it goes up. But because the IL, scares me off, even though people say that isn't that big a deal. But yeah, what's your, how do you make that decision, or,
I think Messi probably has a more technical answer. I would say, as somebody who's much more like you, like trying to find my edge in the farming, in the yield, is find a circle of people, and whether that's someone you follow on Twitter or whether that's someone you can actually chat with in groups, that you really carve out your circle of people. Ideally, like I like to be in rooms filled with people smarter than myself, and I like to just sit there and ask dumb questions, and I'll do that, till the day I die. Like I'll just hang out with people that make me smarter by hanging out with them. And that's where I get a lot of my feedback from. I do a lot of my DeFi on the backs of people who I know did research, know those things, and have that edge established themselves. And it's not like altcoins where, copy trading is not something I'd ever recommend. Whereas in this case, copy yielding, the downside is that because the idea of someone shitting in your pool, so to speak, like if you're getting really nice yield and you have a nice setup and you tell a bunch of people about it, then your yield gets diluted. So it's the polar opposite of altcoins, where people love to tell about their altcoins, so their number goes up. In this case, everything you share, number go down. And so you have to consider that. And that's why having as much of like a private relationship with some of these people as possible. I know that's not the most practical answer, but that is honestly what I've spent a lot of time working on. And thankfully, you've got guys like CryptoMessiah who really look at this stuff in depth and then share pretty much everything right there on Twitter. How do you do it, Messi?
Okay, so I'm sure this is another thing you guys have heard of. Pool 1 and Pool 2, right? And as a total beginner, you might be seeing, Pool 2, like, what the fuck are you talking about? Like, what does that even mean? But basically, for a yield farm, especially a 2020 style, like vegetable, food farm, you're going to have this Pool 1, which is I come in with dollars, I come in with Bitcoin, I come in with Ethereum, I come in with something that's non-native to the actual token of the protocol, right? And I'm going to deposit it into a contract, and just really for my opportunity cost, they're going to pay me. Now, Pool 2 is my exit liquidity. And Pool 2 is going to have a higher interest, a higher APR than Pool 1. And that's for a reason. So a really common noob trap is, they'll come in, they'll see something that can be farmed. And if there is kind of this Pool 1, Pool 2 setup, they're going to say, hey, I could deposit into stables and I could get 30%. Or, wow, look at this. For potato token, right? If I provide liquidity for the actual potato token, the token that's being farmed, they're going to give me 500% APY or APR. That's going to be insane. That's going to be fantastic, right? So you're actually the exit liquidity in that situation. It's something I wouldn't recommend unless you really know what you're doing, unless you're really advanced in it. Stick to Pool 1s, try to stay out of Pool 2s. You may win some, you're probably going to lose some. Just in terms of like finding DeFi projects and, to address your question really, when you find something, for me, it's more if I'm going to be a liquidity provider, if I'm going to participate in their Pool 2, I want to make sure that there's not some Pool 1 dude who's just, SBF, or not SBF, but Alameda, right? Coming in with $100 million, just dumping all over my face, right? You want to make sure there's not that component to it, because a lot of these projects with these DeFi tokens do incentivize their liquidity. Of course, protocol and liquidity is all the rage right now. But if I came into a project, for example, I'm trying to think of a good example, Reflexor, which is something that I'm in. Reflexor, I like to call it Reflexor, though, because I'm all about the or meme. With a Reflexor, basically, being a liquidity provider, they're going to pay you for that in these tokens, right? You get more FLX for your service. If you're really long-term minded about something and your objective is really just to accumulate more of these tokens, you've got to think about, two things. How long is my holding horizon? What's the valuation of this, right? Because if I'm depositing, if I'm going to be a liquidity provider, I don't want to be fucking around with something that's already $3 billion market cap at this phase of the market, right? Like could have a lot of potential downside. If you look at the chart, and the chart is just dildonic, it's straight green dildo. Like, I don't want to be that liquidity provider for that project anymore, because then I'm the exit liquidity. I'm an opportunity for somebody smarter than me to dump on me and get out. But if I'm looking at a chart, it looks relatively flat for a while. I look at the market cap, it's $20 million market cap, but it's a really high quality project. The devs are active, the devs are building. I've got a long-term thesis on it. All I'm interested in is just kind of getting more of that token. Yeah, sure. I might want to jump in there and provide some liquidity and accumulate more of that. Because the thing is, if it does get cut in half, which it very might well, and it goes to $10 million cap, then I can accumulate more. So impermanent loss, the boogeyman, right? And I think I hate how impermanent loss has been portrayed in DeFi, because most people have no idea what it means, what it actually is. And it's just this terrifying thing that everybody's just, like you mentioned, impermanent loss. Like I'm kind of afraid of it, although I've heard I really shouldn't be. Impermanent loss basically just means it's kind of like an opportunity cost relative to just holding directional exposure to an asset. So, for example, let's say I just had raw Ethereum, and Ethereum goes from $2,000 to $4,000, right? Well, I've benefited in all of that upside, and I've captured all of that upside. But let's say instead I have an LP position on something like Uniswap consisting of half dollars and half Ethereum. Well, I have half the exposure to Ethereum, that I would have had otherwise. But the thing is you can think of this AMM as when the price is going up, it's going to be automatically selling your Ethereum to dollars for you as it goes up. And here's the thing, it's going to automatically sell some at $2,001, at $2,002, at $2,003, all the way up to $4,000, right? And it does, on the way down, it buys. It's the exact opposite. So if Ethereum doubles, then would I have made as much money as I would just holding that directional exposure? No, but maybe maximizing the amount of money I make wasn't really the objective. Maybe risk was something that I was considering when I entered this position. And by pairing it versus USD, rather than just shoving my entire stack into Ethereum, I'm actually muting the volatility of that position. So if the position goes against me, I wouldn't lose as much money. But if the position goes, in my way, I don't make as much money, but I still make money. And that's the important thing here. You've got to factor risk into all of this. You've got to calculate risk, and you've got to have kind of a risk-oriented mindset, especially when you're considering, your longevity in this space. Now, of course, look, I'm a fucking degen. I love the YOLO punt. But at a certain point, especially at this phase in the cycle, nobody really fucking knows what's happening next, right? I don't know if Ethereum's going to 10,000 or 1,000 next. So I think it's in my best interest to say, hey, if I am going to try to squeeze this last bit of juice, out of this lemon, which is totally fine, right? We're in crypto. Who fucking knows where this is going? Is it a super cycle? Is it not? And I've made some money. Why don't I try to get that last bit of juice, maybe get a little bit less juice, but still go after it, but also mute the volatility of my position? And that's something I could do by, for example, pairing something versus US dollars, and then depositing that into a yield farm. And now, hey, I've got a volatility muted position. That position's naturally interest bearing, so it's naturally going to accrue value. And then in addition to that, somebody's paying me, food tokens or fucking whatever to provide this liquidity.
That's awesome. Yeah, that helps a lot. So basically, like, farming is sort of reducing your risk on something that may be really volatile. So if you're looking at a newer coin or less trusted coin, it might be better to farm it rather than just go spot and hope it goes up.
It can be. And what I'd recommend, and guys, if you just Google impermanent loss calculator, I think it's important before you enter any LP position to kind of simulate the possible outcomes of that LP position, because where impermanent loss is really going to fuck you up, and where it actually is really nasty. Let's say, for example, I think Spell is a fantastic example, right? I bought Spell really, really low, and I was just holding it. I was single-sided staking it. But let's say I was staking it versus Ethereum, right? And I was being a liquidity provider. I was getting paid Spell to do that. And then Spell goes 100x. Well, like I said before, every tick to the upside, it's going to be selling a little bit of my Spell to Ethereum. So whereas if I had just held that directional exposure, maybe I would have had that 100x, 150x, right? And that would have been insane. Of course, if I managed to hold it that long, if I managed to experience that run. But if I was in that LP position, and it did the same thing, well, holy shit, my 100x maybe just became a 10x or something like that. On really extreme deviation situations like that, where one of the assets on the pool is going to really deviate in price from the other asset in the pool, that's a position where impermanent loss will really fuck you up, and where being a liquidity provider doesn't make any sense. So it's more of let's say the correct way to do it, because Spell ranged down there, for a while. You have to be active about it. And let's say I said, okay, I'm going to provide liquidity for this. I don't know what the bottom of this asset is. So you can actually use this to your advantage. I don't know what the bottom is. I know it's a good project. I know it's low cap, and I'm interested in accumulating more. Well, then I can be a liquidity provider. And let's say Spell gets chopped in half, right? And it loses 50% of its value. Well, guess what? My LP position has been buying that dip the entire time. And what I can do when I feel like, hey, this is just getting fucking ridiculous how cheap this asset is, I can then pull my LP position, which has accumulated more Spell. I can take the other side, that Ethereum, I can buy into Spell, and I can really, really kind of increase my stack, all, while being paid to do it. So the thing is, being an LP, being a farmer for a project, especially like something that's low cap, is a really good thing if you don't expect those extreme price deviations in any of the assets in the LP position for an extended duration. And you have to have that awareness to know that you're going to need to manage it. If it goes low enough, you might want to pull and punt the other side of your LP position, that Ethereum component, and dispel. And if it breaks out of that range, if you don't think it's going to be going sideways anymore, you might want to do the same thing.
That's awesome. Yeah, I hadn't considered that. That's a great strategy. Thanks. That really answers my question.
Yeah, no problem, brother.
So this is technical, guys. As I said, thankfully we are recording this episode. So if you want to check it out on YouTube, on Spotify, it'll be up there a little bit later today. And let's go to the next question. Oh, quick thing. APY.vision. I don't know if you use that, Messi, but it's something I just bought my Vision tokens back to get like the pro version yesterday. That has helped me a lot because it kind of reads the blockchain and tells you your impermanent loss and all that. There is a basic plan. I don't know what it gives you. But just a heads up, that's probably my favorite tool for farming. And I only just got it back after playing with it earlier this year. So APY.vision is kind of dope for calculating, cost basis and all that stuff, especially for taxes. Okay, moving on. Let's get Pangolin. I see Pangolin's up here to speak. What do you got?
Hey, guys. Great talk so far. I had a bit of a question for all the new peoples. You are receiving a token in return, say it's Pangolin or Uni, whatever, for farming. What's your vision on what you do with that? Are you a seller? Are you taking it into level 2? Could you give people an overview on that?
Yeah. Okay. So in the context of Pangolin, right? Beloved Avalanche project. Pangolin is that pool 1, pool 2 situation. Now, pool 2 isn't, pool 2 is kind of like impermanent loss. If you know what you're doing and you understand what you're doing, you can kind of bend these things in your favor. But on Pangolin or even Trader Joe or really any exchange that's incentivizing liquidity, you're going to have these pool 1s, which is, hey, I'm providing liquidity for AVAX token versus USDC versus USDT, whatever. And these exchanges are incentivizing this liquidity by, giving you PNG, by giving you Joe, whatever. Now, these exchanges also have liquidity pools for this token that they're using to incentivize people. So one of the biggest, I guess, determinants on what I do next is actually the amount of value accrual to balance out, to counterbalance the selling pressure for that, what I call them farm tokens, right? But there has to be enough value accrual to that farm token, because even Curve, which is one of my largest positions, it's a farm token, right? But it's got all these value accrual mechanisms. It pays dollars. It has voting rights, so it does have value. You have to make sure that has enough value accrual to balance out the selling there. And a lot of that too is dependent on market conditions. In the context of Pangolin, is Pangolin exchange growing? Is are the fundamentals improving? Is the value accrual to the PNG token increasing? Are more users using the exchange? Is there a reason to actually have? Is there a purpose to this token? Does this token accrue value? Does it have meaning? Or is it just kind of a farming reward? That's kind of my first step in evaluating what the next step to do is. Because farm and dump can be really cost prohibitive. Although on somewhere like Avalanche, of course it only costs pennies, so you can do that effectively and kind of take that off the table. But I personally, in this situation, I would farm whatever token that was, for whatever AMM, whatever exchange was providing me these rewards. And then I'd wait for a green day and I'd probably offload it in one shot if I wasn't interested in accumulating that. But if there was a reason to accumulate that token, maybe this is just a means to do that. Now, another farming thing to remember, guys, when you accrue these farming rewards, that's not a taxable event. So, of course, gross taxes, bro. Stop talking about that. Like, fuck taxes. You got to pay your taxes if you ever want to see any of this money in the real world. It just is what it is. I mean, you can be magic internet money rich and you can be that cyber warrior that never pays anything. That's not what I'm trying to be. I'm trying to improve my actual life. So what the taxable event is actually the claiming action, right? So for example, like right now, I have a lot of farm rewards that haven't been claimed yet because I'm waiting until 2022 to claim those rewards because I don't want anything else on my 2021 tax year. But when 2022 rolls around, hey, I've got the whole year ahead of me. I can go ahead and start claiming and, efficiently compounding that. Now, one of the really interesting things on something like Avalanche or any of these other L1s that are really cheap and fast and efficient is they have these things called auto compounders. So auto compounders actually just take what I've just described and they automate it for you. And they do it efficiently to increase your yield over time. So an auto compounder is going to take your yield, which most of the times is APR. APR is just simple interest, guys. And it converts it to APY, which is compounding interest. Now to actually, feel the effects of compounding interest, to actually benefit from compound interest, it's got to be a longer term thing. It's got to be a bigger number than the APR. But if Yield Yak is my favorite on Avalanche, if I was in a pangolin farm and I wanted to enter an auto compounder on a US dollar position, it's going to constantly take those PNG rewards I get, and it's going to automatically sell them for USD. Now, that's actually going to increase the liquidity on the exchange. It's going to increase the size of my position, and because my position's bigger, theoretically, I'm going to farm more, right? But yeah, it's all a matter of value accrual and also your strategy. Tax planning, gas planning. When I say gas planning, I mean, where the fuck are you farming? Is it expensive to compound frequently on your own? Like, are you going to try to play directional movements, with those farm awards? Like, what are you trying to do?
Yeah, there's a lot there. It's a very nuanced conversation. I think it really starts and ends with your own personal goals. But to offer a simplified solution, and I can go over this more in depth on Hero Labs Live on Friday. So if any of you guys are around 3 p.m. Eastern, I'll be on there so I can actually pull up a chart. But I use the 12 and 26 EMA. It's a slightly faster moving average than a lot of the ones you'll see on most charts. Kind of a typical, and kind of a TradFi set of moving averages. And I'll use Joe as an example. When it's trending up on the daily, I just kind of stack those rewards, compound them back into the farms. And if that trend flips to down, I just sell them. I sell them on the next bounce. And I find that is a common thing. You see these farm and dump tokens, quote unquote. They often do struggle more in downtrends. And then, during the uptrends, it's like nobody's selling them anymore. So that's a simplified sort of rule-based set that I use. It might help you guys out. Okay, thanks for that question, Pangolin. Let's talk to DeFi Don.
Yo, what's good, guys? How's it going?
Hey.
Yeah, big fan of the show. So I just kind of wanted to ask a little more of a broad question. Obviously, crypto is incredibly fast paced as well as DeFi, especially with all the new alternative L1s and everything moving so fast. I was wondering, especially right now, what are you guys kind of doing in terms of strategy? Do you kind of just like to have a more simple executable strategy where you just you got your base or whatever, your collateral on AAVE or whatever, and you're stable farming on Curve, kind of very simple, not high risk type, you can just chill plays? Or are you chasing more degen stuff, going to the next L1, following the capital rotation type thing? And I think it's all also dependent on your portfolio size as well. But I'm just curious, how are you guys thinking about it right now? Because it seems I'm struggling trying to figure it all out and thinking about it all.
Yeah, there's a lot to unpack there, and that's actually what I'm spending a lot of December doing. Portfolio has shifted a lot this year, and so I need to really reassess how I'm allocating and how I'm spending my time, energy, and money, and how to really secure the bag while also staying long crypto, because I am very bullish on it. And I think, well, I mentioned this earlier, but stablecoin yields, LP positions that are half stablecoin, and then volatile yields, what I call them, which are either two cryptos that move up and down against USD, or single asset staking. Now that's three sections of my sort of risk when it comes to DeFi yields. Stablecoin yields, they're boring, right? They're 5 to 13%, depending where you're getting them. But that's a really strong base. And it's, again, like you said, it also depends on portfolio size. If I had $2,000, I probably wouldn't have 50% of that getting 4% a year. You know, at the smaller account size, which is where I started a few years ago, I think it was the rotation game through altcoins during the right seasons that really gave me the base to now start to play with more boring yields a little bit. I try to keep a certain amount in volatile stuff because I like the potential upside. Those can be very seasonal. And that's, again, going back to, like, I feel like I want to show somebody a chart every time I'm talking on here. So if you guys ever want, I do have those charts. It might be a little easier to watch this, but that's sort of where I'm at with yields. And like everything else, it is very nuanced. So if you guys are here watching this, listening to this, and you're saying, man, this is so much to take in, you know, where's my just click and go strategy? It doesn't really exist yet. And so what I would just encourage you to do is zoom out, have a longer tailed sort of goal set here, and don't worry about not necessarily having a set plan now. You know, play with the data, learn. I've been learning DeFi stuff now directly for 6 months. And I only just made my first spreadsheet yesterday. I mean, it is a long game for me, and I think that helped me not worry too much that I'm not getting it. So, if you don't get the perfect solution today, don't sweat it. This is just one step in a longer learning experience. What do you got, Messi?
I mean, look, I think once again, risk is a good thing to talk about, and also, you know, RT brought up, like, if you got $2,000, which I had less than that when I started, actually, much less. I had less than $1,000. So I know what that's like. I know it was a different day and age, of course, you know, but I know what it feels like to have a super small portfolio. If you do have a really small portfolio, you're going to do better just staying away from all of this. And the reason I say that is, you know, yield farming, I think, is something that you need a certain amount of money to do. And that exact amount, you know, for example, if I didn't have like at least $100,000, I probably wouldn't be fucking around with yield farming on Ethereum at all. The gas costs are too prohibitive. What ends up happening to so many people is, you know, they'll deposit on even Convex, which is a fucking awesome yield farm, right? It's incredible. People will deposit their $10,000 on Convex, and they'll farm for a month or two, and then they withdraw their rewards, and they go, "Hey, what the fuck? I only have, you know, $9,800 now. Like, what the fuck happened?" Well, you know what?
That happened to me.
Yeah, you pay the gas costs for staking, you know, because really there's multiple gas costs associated here, right? You've got an approval. So, okay, yeah, I give this contract permission, you know, to interact with me, you know, interact with my wallet. So you got that approval, and you're going to pay gas for that. And that's typically like a one-time thing. Although, you know, I do think that it's a better practice, especially, you know, when you're trading and stuff, when you only approve it for the amount that you're trying to spend. We can talk about that in a later episode. But you're going to pay gas for that. You're going to then pay gas again to stake, and then you're then going to pay gas again to unstake. So that's kind of part of the conversation, especially if you're just going to you know, farm an Ethereum base layer. If you've got a smaller portfolio size, you know, there 9 times out of 10 that yield farm isn't going to be worth it, because you're going to get in that situation to where you're going to get in the farm. You're going to stake. You're probably going to get fucking bored. You know, you're going to see something else. You get out of the farm. And what the fuck? I was farming with stables. How did I lose money? Well, you know, the gas ate you up. And that's why, you know, if you are going to yield farm with a size under, I'd say around $100,000, you know, maybe somebody else would even say more. I would really, really try to focus on some of these cheaper L1s, you know, whether that be Avalanche, Solana, whether that be Phantom. There's definitely a lot of options out there for you. Because when you're farming an Avalanche, for example, you take that gas cost out of the equation. And, you know, I can come in with $10,000. I can say, hey, I really don't know where the fuck's going to go on with the market right now, you know, but I'd love to make an extra $200-300 in the meantime. Like, okay, yeah, sure. You know, I can deposit in a yield farm. You know, I could go to Yield Yak and do some auto compounding on Penguin or Trader Joe or whatever. And then I can unstake, and you know, that whole, you do the same approval, staking, unstaking, but, you know, those actions then are going to cost you, you know, cents instead of hundreds of dollars. So it makes things a little bit more manageable in that regard.
Yeah.
Yeah, 100%. Oh, sorry, RT, you have something?
No, go. I was just going to say that was the big eye-opener for me when I really started messing with DeFi, was when I found out that I could get in and out, collect data, small amounts, because I don't want to punt in, a huge amount to something I haven't tested before. So Avalanche, those fees, Trader Joe in particular, help me do that.
And look, this is the final thing I have to say in regards to this question. Like, I'm sure you've seen these gigabrains, or at least alleged gigabrains, on Twitter posting these super complex strategies. Now, I'm going to deposit here, and then I'm going to take out a loan against this, and then I deposit here and take a loan out against that, and then I split this up into this and this. And, it's like, dude, what the fuck? Like, you described like 8 steps, and like, can you imagine the gas costs associated with that and just the complexity? And every layer of complexity you're adding to your farming strategy is another layer of risk. So the way I see it, survival here, and this is what so few people understand, survival here is everything. Just about all of you listening, just about all of you will make it if you can just last long enough.
Just be here in 2026, 2028, 2030.
Yeah, if you can make it, if you can just survive, you're going to make it in some regard. You're going to be able to make money. You're going to be able to improve your life. Those opportunities are going to fall. You are going to hit some lotteries. You're going to hit some home runs. Like, it's just inevitable given time in the system. So don't ever put yourself in a position to where you've layered so much risk in your portfolio that, hey, fuck, I got rugged. This got hacked. Like, I lost my money here, lost my money there. If you can just survive and not try to get rich tomorrow, you're going to make it. You're going to be okay. That's easier said than done, right? But when it comes to my farming, I like really simple stuff. And the most complex that I would ever get is, like, for example, if I took my spell position and I went to Abra and I deposited that spell, I took out some MEM against it, and then I said, hey, I'm going to farm with that MEM that I've taken out against my spell. But here's the thing. Okay, I've taken a loan against my spell. Like, maybe I only want to borrow at 20% LTV. So if I've got $1 million of spell, maybe I borrow $200,000 and I farm with that. And that ensures that, hey, I'm not going to get liquidated on that spell position. And also that I get to farm somewhere. But even then, I do something as simple as possible, just to reduce the layers of risk, the complexity. Is it really worth layering on all of that fucking risk and trying to have that gigabrain strategy? When you have gas costs, when you have potential for exploit at every layer you've added, like, those kinds of things just don't make sense to me. So keep it simple. If you do have over like $100,000 and you want to park some like dollars on Ethereum, for example, I love the Curve 3 pool. Now, 3 pool is just an LP token, okay? It's an AMM position like we were talking about with Uniswap, except for this one is comprised of 1/3 DAI, theoretically, 1/3 USDC, 1/3 USDT. So I'm earning interest on that 3 pool. And then I can come deposit that on Convex. And, Convex is a really great platform, really great yield farm. Convex token, we were talking about how do you know, the question from Pangolin, how do you know whether to just farm and dump, or do I want to farm and accumulate? Convex has done a really good job of creating a lot of demand for their Convex token. So, maybe I'm interested in farming that Convex token and staking that Convex token, or maybe I'm just farming and dumping it because I'm just, a mercenary and I'm trying to get mine and get out. It really just depends. But just in terms of simplicity, lowest risk possible, in my opinion, on Ethereum, you got over $100,000, deposit into Curve. Curve is a really safe base layer of risk. Go into Convex after that, call it a day, be done with it. With the smaller stack, if you want the lowest layer of risk possible, deposit straight into Curve on Avalanche, and then deposit that LP token into their gauge, and then, earn those AVAX and Curve rewards.
Yeah, no, thanks, man. That all makes perfect sense. And like I'm just like in this interesting, like I'm a big gamer, so obviously all about like optimizing strategy. So it's like a very interesting spot of like, am I supposed to how much degen and how much am I supposed to be conservative?
I mean, the urge for most people here is to go max degen, right? And especially as a gamer, when you're trying to like maximize a build or something, because I'm a big gamer too, and I spend so much time trying out different builds and different combinations and things like that. For DeFi, I think the simpler it is, the better it is.
No, I feel that, man. I feel that. Like, simple executable strategy is something I learned in poker.
Simple and effective, repeatable. And while, again, with compound gains over time, this whole idea of like just survive. My first 2-3 years trading, the idea of risking 1% per trade was boring. I was like, oh, I'm going to risk $12. I'm going to risk $40. But you spend a few years growing an account, and that can come from yields. It can come from DeFi. And if you survive and you avoid, you should really have 4 types of trades, or in this case, transactions, right? Big winners, small losers, or break even. You should never have big losers. You try to avoid those at all costs. And if you can do that, suddenly that sort of boring, simple, basic, low risk, conservative stuff is going to end up being, 1% of your portfolio is $10,000, and now you're risking one, but you haven't changed anything. You're still just risking 1%, for an example. So it does start boring, and that first 2 years can be really boring if that's how long it takes, whatever it is. But I would say stick to it. All the people I know who came in small and said, "Oh, I got to take huge risk because I'm a tiny account." Well, they still have a tiny account because they keep refunding it with their latest paycheck because they can't grow it because they take too much risk.
Yep. I had a buddy who got wrecked. Actually, Messi from the thing you were talking about earlier with the spell ETH LP. He was very early, but lost out on all his gains. And then, oh, dude! And then he got it liquidated later because he borrowed against. I don't. It's brutal. Brutal. All right, I don't want to hog the stage, but thank you guys for
great question, bro. Thanks for
appreciate it. Yeah,
thank you guys. Love what you do. Take care, y'all.
All right, man.
Cheers, man. Froggy Style, get up here. Love the name.
Oh, thank you. Thanks, guys. I wanted to kind of, because I thought it'd be helpful for newer folks to hear this as well. Plus, I'm kind of going through this now, being the end of the year. So kind of zooming back out, portfolio construction as well as tax planning for those of us who perhaps live in Canada or the U.S. Or other jurisdictions which already have kind of are planning to have tax liabilities this year. One of the worst situations I think you could find yourself in is if you've received airdrops, stake and rewards, yield farming, gains, which are all going to be considered income and short-term capital gains, essentially. And then, the position where maybe those have also gone down in value, and now you don't have enough cash to cover your tax liabilities come April or come October if you do an extension of 2022. And now you have to sell more of the assets that you wanted to hold longer term. Maybe you have to sell, 10 ETH in the middle of next year versus, having that money right now put in stables. I just wanted to kind of hear from both of you how you position yourself to make sure, kind of going back to that, always having stables, which are a lot more liquid if you need to, convert them to fiat to cover your taxes. How do you kind of think about that with the things you've experienced over the years, and what kind of advice you might give to some of us newer folks who maybe haven't gone even through a whole calendar year in the market yet? Thank you.
Yeah, this is a deep, long conversation. I think we could do an hour on taxes in crypto. I can speak as briefly as possible. I've spent an enormous amount of time in the last 3 months, 4 months even, trying to get that together for myself and learning a ton about this, to a point. I think there's a fine line between having such a small account that it's negligible and it's sort of like ignorance is bliss. And I have buddies that, early on, they're just like, well, if it hits my bank, I'll declare it as capital gains and I'll just pay, a net tax on it. But the reality is every time you do a transaction, every time you close a trade, it's a taxable event. And I used to hear that, and years past, I didn't do that. I did the capital gain claim on what hit my bank. This year, I realized I need to get it together. I've hired an accountant firm, and they even know crypto fairly well. And it's still just 6 different chains, staking rewards, like you said, airdrops, sending random coins to people sometimes on a giveaway or something. They're like, well, what the hell was that? I'm like, I don't know. It is, I think the net takeaway that I got from it was, first of all, don't think that the IRS or CRA are stupid. They have years to catch up to this stuff, and they will use scanning software, and they'll be like, we're going to look through your wallets. We can map them. So I think if you've had a really good year, I would take this seriously, and I would personally, recommend doing what you can to get it right. And I think the biggest takeaway I got is the accountant I have, we're not going to get it perfect. We're not going to get every penny perfectly done. Some of the swaps I do go through 7 different pairs before they hit the pair I swap to, and it's a moving target. So he just said, but look at our workbook. He's like, look at our Excel, look at our workbook. You've spent the money, you've spent the time putting this together. They're going to look at that. They're going to say, next, because they see that they're up against it. And there's a pretty good chance that if you come up with a number showing that you've really gone through it and done a ton of due diligence on it, that they'll probably ask for starting balance, ending balance for all your wallets and exchanges. And then they'll see if that matches your sort of declaration. And they'll see like a 200-page workbook, and they'll be like, good enough. And that's kind of where I ended with them last week on the call. But if it's a little more basic and you're homemade, you're doing it yourself, I think, token tax is starting to catch up with some of the more DeFi stuff. They have a VIP thing that they'll actually come in and do some of what I just described for you if you give them CSV files. So that's maybe like a little lighter version. But the TLDR is like, I would take it seriously unless, if you have gains under a few $1,000 where like worst case, oh no, you got busted, there's an audit and you owe something that you can afford to pay back. But I kind of worry about that. That's my greatest fear, is that at the end of this year, have a good year and then hold on to some shit coins. And then next year I get a big nasty, tax bill or audit. And then, like I'm underwater and I can't even pay it. Like, so I'm taking measures to put that in the can't happen pile. And a big part of that was taking profits like fairly aggressively over the year, which is kind of a catch-22, right? Because it's more taxable events. So it's like, I'm going to owe more tax, but the hard part was sitting on those stables and not just aping back into the next uptrend, because
like what you've described is absolute nightmare fuel.
Yeah.
And it can happen. Like the cycle top very well could be in. We do have like tapering coming up and all these, economic, potentially negative economic catalysts in the future. Counterbalancing that, we have a potential like hyperinflation, kind of situation where investors are like, well, where the fuck do I even go, at this point? And crypto is a really good candidate for where the money goes, because we have yield, we have upside, we have growth potential when, a lot of the rest of the market theoretically could be kind of topped out. But let's say hypothetically the top is in, everybody is euphoric right now, even though the chart's not straight green dildo. We've had a great run. We've made some money. Here's the thing, taxes are year by year. So you could very well get into a situation where next year your tax liabilities either end up eating up your entire portfolio, like RT was saying, you've got to sell all of your assets to cover those tax liabilities, or even worse, your tax liabilities are greater than the amount of money you actually have. And I think something like that actually happened to Peter McCormick, who runs a popular podcast on Bitcoin. So it's just something to think about. The way I'm addressing it, and we discussed kind of optimal portfolio construction earlier, and having that US dollar component, have enough dollars set to the side to where the vast majority of your tax liability is covered. And the quick and dirty, easy way to do that is just to assume that everything you have, 40% of that needs to be in dollars. If you want to be 100% stress-free about it, right? Because now, the tax year rolls around. Let's say everything I have has gone down to 80%, but I did make sure that while I had money, while I had these gains, while I was in a good position, I had set all these dollars to the side. Rather than having to liquidate my entire portfolio, maybe I only have to liquidate 10% of it. And once again, that keeps me in the game. If you want to be stress-free, just have the shit set to the side. Also, with airdrops, with farming, with anything you're doing, it's not taxable until it's claimed. So if you do have unclaimed rewards and shit like that right now, do yourself a favor. Just wait to claim them. If the airdrop doesn't have to be claimed within a certain period of time, why don't you wait and see if it's even worth claiming that airdrop? A lot of these airdrops anyway, like look at ENS, for example. The airdrop happens, you've got that initial sell-off from the people taking that free money off the table, and then it fucking moons. Like, it's not only intelligent tax planning, because, what if this airdrop ain't shit and it never is shit? Okay, well, you never have to claim it. Who gives a fuck? But if it ends up being something, and it makes sense to claim it, yeah, go ahead and do it.
Dude, I think I claimed ENS and sold it at the Pico bottom. like a week ago, I was like, oh yeah, I think I have an ENS thing, and I went and got it, and I was like, I'll also sell this. And
It's tale as old as time, man.
So stupid. I didn't even look at the chart. It literally just happened to be the day.
Like RT was saying though, guys, if you do take money into the real world, you got to pay your taxes. And look, they might be total retards about it right now, but there will be a time in the future, and the blockchain is forever, to where they have the tools to go back and analyze and look at all this shit. And I don't think there's any statute of limitations on things like this.
In Canada, it's 3 years. They can go back and audit. And then if they suspect foul play, which would be, for example, avoiding declaring your crypto, they can go back 7 years. And, I got a family. I got a house now. Thank God, crypto helped me get that. But I don't want to sleep on maybe I get it's 15 to 20% chance on the high end that you get audited at all. I don't want to sleep with that risk. I swim in risk I eat risk for breakfast, lunch, and dinner. I don't need all that. So, if you guys want to talk more about tax, we can have another chat about this, because I'm right there with you.
What we'll actually do, I'm going to reach out to Token Tax today, and I'm going to get one of their tax professionals on a few.
Ooh, that's a great end of your guest. Let's do it.
Yeah, that's honestly a baller guest.
Hell yeah,
and they're super helpful. And look, I know taxes are so gross and ugly, and I know it's something nobody wants to talk about, but
I hate them.
Look, me too, but
I hate dealing with them. I agree with, look,
it's fucked up, taxation without representation.
Now, it's nice to have schools and hospitals, but dealing with this has been the bane of my year. I shouldn't be. I should wait till tax season, but I've been doing it early, and it's stressing me the fuck out. So if you guys are in that position, you're not alone. But let's learn this shit, because eventually, and I'm looking forward to next year, because I have some things I've learned now. So January 1st, it's a new year. Silly little thing, like, for example, when I'm on Uniswap, my accountant said, don't swap from one shitcoin to another. He's like, go to USD and every single pair, every single trade. He's like, it'll make your accounting 1,000 times easier, 5x more work when I swap the other way, which sucks. I mean, it kind of limits me, but it's not the end of the world, especially if it's a cheaper chain. On AVAX, I can just go to USD or MEM and then go to the coin I want. And that alone is like a little tip he shared. He's like, for next year. So look, if it's a long game, this is the year I learned all this shit. But it's worth the time, I think, to avoid catastrophe. So I hope that helps with your question. Sounds like we can get Token Tax on here to chat. Let's get to the next one. We've got Botter Boy. What do you got?
Thank you. I really appreciate it. All the information has been incredibly helpful. I'll be really quick. I don't know if we discussed this already, but how are we feeling about rebase projects? As far as, I don't know if you would call that yield farming, I guess so, but as far as bonding, and I think every chain now has a different rebase project.
Yeah, sure. I was a big fan of them before 3.3 with Dollar Protocol last year, just messing around. I had some success with them. They all bled out to zero, ESD, DSD. I don't know where they're at now. They're all kind of dead. Ohm really changed the game. We've had a massive wave really kicking off with Wonderland Time and that sort of fork, and now it just turned into fork season. I think it hit its highs in Mania, and now it's my 2 cents. And I mentioned this in, I don't know where, yesterday, chat or on stream, but I think it's just time to wash it out. I mean, I don't think that should be news to anybody. You look at Ohm, you look at Wonderland, they're all kind of testing liquidation levels on Boros.
Market cycles.
It's a tale as old as time, right? You're going to have, it's the same with any mania, right? Something works really well. Everyone sees the dollar signs. They go after it. It dilutes the pool of investors or holders or buyers or speculators, and then it runs flat. And what ends up happening is you bubble, and then they flatten out, and the shit dies and stays down there. And then the strength, it kind of consolidates back to what you might call blue chips or whatever. And then you consolidate sideways for a certain amount of time, and then you start into, ideally, a next bull cycle, which is what I'm holding for the ones that I have. But as of right now, none of them really are trending up. So as a trend trader, none of them are a buy for me at this moment. But there's also, they're kind of not really a sell either. They're down now. So I'm just staking and moving sideways with them, hopefully from here, and we'll see where they end up.
Thank you. I really appreciate that.
But yeah, that's cycles. That's not really unique to 3.3s in Ohm forks and all that. They just saw what we've seen with all kinds of different coins. Did you have anything you wanted to add there, Messi?
No, I think you nailed that. Look, market cycle, it doesn't matter if it's Ohm, doesn't matter if it's Wonderland. Things go up, people make money, profit taking happens, things go down, selling happens, reaccumulation hopefully happens. What's really interesting about things like Olympus DAO, Luigi, if you're listening, that's for you. Luigi hates it when I say DAO instead of DAO. But things like that are really interesting because not only did it introduce the concept of protocol and liquidity, but they also mimic fractional reserve banking. And theoretically, these are new DeFi primitives. So whereas, we've all played these, rebase Ponzi's and algorithmic stablecoin games like empty set dollar or dynamic set dollar or what was the one you said, RT, that you were big on?
Dollar Protocol.
Yeah, Dollar Protocol. Those all eventually fell apart. And maybe Olympus and Wonderland and all that falls apart too. But I think that they're unique in that they're backed. And when you go look at the dashboards of these things, you're going to see a backing per asset. That's the amount of assets that actually, in the event of a bank run, everybody decides to sell or whatever. Like, okay, well, they can take that and they can distribute that. And that's the minimum value for all of those coins. It kind of puts in a floor on everything. Theoretically, things like Olympus, like Wonderland, they're going to trend towards much, much lower numbers over time. So you can't look at these things in terms of the price of the asset. You have to look at it in terms of the market capitalization and what percent of that supply do you own? Because through the rebases and stuff, the percentage that you own of the supply is going to remain the same. And, you might end up 3 years down the road right now. If you have $100,000 in Wonderland, Wonderland might be $1 per token. But you might have a lot more of it and you might end up, above where you started. If it's something that's going to last, these kind of fractional reserve assets, that's kind of the future, of what I can see. So you might look at the chart in 3 months and you might say, hey, like this shit's at $5,000, that's bullshit. It's been going sideways for 3 months, right? But the people that have been staking, might be up 3x or something like that. Without getting into, huge detail, I think the jury's still out on whether these things have staying power or not in crypto. But I do think that there's a chance.
Yeah, and on a technical side, time just hit oversold on the daily RSI for the first time ever. And that's typically, with the elasticity of markets, something you need to see. Overbought, oversold, overbought, oversold, ranging, trending. So I'm curious to see how it holds up. Ohm is the godfather of this protocol model, and it dropped something like 90-something% after its initial launch hype. So we'll see. I'm going to go over all these charts again on Friday. So again, I'm looking at a chart here like I wish I could show you guys. But we'll take a look at that more visually. For anyone who's interested, you can follow me on Twitter. But otherwise, I think we should get to the next question. We got a couple more. We are getting into that hour and a half phase of the show. Let's see what Share Wizard's got. What do you got?
Hey, guys. This has been incredibly valuable. Really appreciate it. Kind of smiling. Feel like I'm in the right place, right time. And this is just pulling on the thread that Froggy, who probably said it better than I'm about to say it, which is kind of coming to this realization from the question comes from the perspective of someone that hasn't quite made it, isn't just a pure stable incumer, but wants to be like a rotator, hybrid rotator incumer, yield farmer, and does okay. But then, like you guys said, gets to the point where, oh shit, actually on paper, is going to owe a lot of taxes. And then this whole year might have been just one big wash or in the negative. So from the perspective of someone that wants to outperform just a regular yield farmer or stable farmer and wants to play the rotation game, I'm just reflecting on what could I do differently next year so that I can, better strategize to have what I need for tax season come next year. And you gave a couple of great tips already, that 40% mindset, Messi, that you were talking about, and claiming airdrops. And I just wanted to stay here for one more second to see if there's anything else on this thread that could be pulled that, if you were talking to yourself from, a couple of years ago, if you'd be like, hey, this is the stuff that you should be doing intentionally as you are kind of doing this rotation game and yield playing game?
I've actually got a really good short answer to this. Look, if you're still like on your grind trying to make it, which there's no shame in that. Everybody that's made it, was on that grind. Like I said, back in the day, I started with literally $300 to my name. Okay. And I didn't put money in crypto. Beyond that, I just survived. And I ended up having opportunities fall into my lap. If you're trying to make it, the best way to make it is going to be through gems. And when we're talking gems, I'm talking about things that are like, maybe 10, 20, $30 million market cap. If you found a quote gem and it's a $300,000 market cap, there's probably a reason that it's a $300,000 market cap and it hasn't been marked up, 9 times out of 10 at least. But you're going to want to find gems because you're going to want to have some kind of really big windfall that allows you to advance to a couple levels with your portfolio size. Now, if you do manage to find one of those, and if you do stumble on something like that, you've got to bleed it, when it's going up and everybody's celebrating, and you found the chosen one, right? If you are 3, 4, 5x on it, shave a little bit off, but also when you're shaving off, don't be so eager to shave off into the next shitcoin immediately trying to compound. You're in a state of mind in that point in time where you're just a god, right? And maybe you do have something else lined up and it is fantastic. And, you're advanced enough to realize that and be able to do that. But when you're taking profit, I like taking profit to dollars because the thing is those dollars are stable, right? You can use them to pay your taxes, you can farm, you can do all sorts of shit with them. And they're an important part of every portfolio. But as long as, you're allocating to those gems, you're not burning all your fucking money trying to yield farm and, trying to live that farmer glory. If you do have that windfall, just be going to cash and be very patient about your next move. As long as you're doing that, you're not going to be worried about taxes or anything because at the end of the day, you're just a guy, that's kind of made it, has stepped up his game, has gone to the next level, has this cash bag. And then if you decide to do that again, you can do the same thing. Like, hey, I had $10,000. I got super lucky. Now I have $100,000. I'm going to allocate in this thing. And with $100,000, maybe you're looking at a $50 million market cap, because you need like a more liquid project. You want to be selling always, and you want to be selling to dollars, and you don't want to have FOMO with those dollars. You want to have those dollars ready for amazing opportunities because guys, there's thousands of coins out there. There's thousands of opportunities. Given time in this space, you will find something else that just makes sense, that you can bend to your will.
Love that. Thank you.
Appreciate the energy. Share Wizard. That was a great intro. Let's get, I'm saving you for last, bro. Astro CF, what do you got?
Saving me for last. I know it makes sense.
We're saving the disgusting gray
he who shall not be named, the gray.
Oh.
No, we'll save him for last. Astro CF, you're best for last here. What do you got?
Well, thank you, bud. Honestly, I just real quick before I get into what I want some insight and your guys' thoughts on it. RT, just got to give you the shout out, man. Always saying play from position of strength is like, that just is like ingrained into my mind. And when I saw that liquidation cascade, I know that's forced selling, and I want to be a voluntary buyer when I see some forced selling. And I was like, this is a position of strength right here. And then I recently sold that when we started hitting this recent resistance again. And no shame, no care, building my stable stack. And that was like one of the first position of strength plays for me, and I just want to give you that shout out for that. I mean, I swear you must like secretly trade with the moon or something because you kill it, man. You kill it. But
well, I appreciate that a lot. I do say it every episode, and I don't always do it myself. So if anyone is doing that, I'm always happy to hear it.
Yeah. And also, Yeah, that's mainly why I'm keeping money on Avalanche. I'm an FTM guy myself, just because I like the degen farms and all that crap on there. But I couldn't buy the dip on Phantom. I mean, it was vaporware when actual real life volatility hit the chain. And AVAX, yeah, the fees were like, I think I paid like $9 and then like $10 for another, but I was able to buy death, and that was cool. So I profited big. So big shout out to AVAX. Just you can tell the tech is there for that. Even though I'm an FTM guy myself, you know you got to give respect where it's due. And my question is, I recently bought some wrapped Memo on Phantom. I I think my play is going to be to pair that with MIM and LP that, because in my mind, I'm thinking that these tokens are probably going to go down over time. But best case scenario, it kind of stays the same. Maybe that's just with time. I don't know about wrapped Memo, but or memo, whatever it is. But I was thinking pairing that with a stable coin would give me less directional risk, because I'm not thinking it's going to go up fat. If anything, it's probably going to go down over time. So I just want to hear thoughts on that. If, you know, in volatile situations, I like to pair against stables too, because, you know, 1 week I'm like, wow, I just lost a lot of impermanent loss to the downside. And then the next week, you know, it's like none of that ever happened. And then impermanent loss to the upside. But when it's volatile, I like having a stable pair because I can probably get out about break even with the IL. But you know, you're making like, you know, 100, 200, 300% APR, which is just so much better than pairing it against another asset that might have less loss. So I just want your guys' opinion on that wrapped memo pool paired with MIM, if that's like a cool long-term farming idea, if you guys have any insight on that.
Okay, so wrapped memo, and I think MEMO, I think it's short for memories. So I've always called it memo, but I think it's one of those things like Ethereum where, you know, some people call it ETH, some people call it ETH. I think you can call it whatever you want it. So what wrapped memo actually is, WMEMO, for anybody that has seen that on an alternative chain, is it's actually a container for memo, which is a rebasing token. So even if, for example, time is going down, right? Memo is a theoretical, you know, it's not theoretical, it's a one-to-one receipt for the time token, but the memo token actually rebases and it's redeemable for the same amount of time at any point in time. Now, when things are happening inside this container, right, it's not a rebasing token, but the wrapped memo reflects the value of the tokens within that container. So theoretically, that could be stable and that could be a really good play in the sense that, hey, you know, even if time is downtrending because of the rebasing that's happening with memo inside this WMEMO container, the value of WMEMO could remain relatively stable. Even if it's downtrending, even if it's going down a little bit, it's not going to just totally nuke given time, right? So that paired against a dollar asset, a stable coin, could be a decent play or even a really good play just if it works out. How about that? You know, if these fractionalized reserve assets end up making it the distance, and they very well might make it the distance. You know, getting 300% APY, APR, whatever it is on a setup like that is also interesting because in the context of an impermanent loss, you know, given time, even if time dumps a lot, you know, and you're catching all those rebases, maybe the value you've put in that doesn't dump, right? So there might not be a lot of impermanent loss between WMEMO and the dollar, and 300% is really good. But I think a lot of this just hinges on these fractional reserve assets making it the distance or not making it the distance. You do, you know, have to remember, of course, that all of these fractional reserve assets are backed. So when you take into consideration the amount of backing in the assets, you can kind of calculate and run the simulations for the edge cases, to where it does hit that floor. And there's a run on the bank and treasury assets are distributed or whatever. But yeah, I think just without really getting into it and looking at it, I think that could be a smart play. And, I think you're thinking about this in the right way, as long as you just understand the risks associated, with the WMEMO component of that equation.
Yeah, that's helpful. I think what I'm going to do is I'm just going to dabble a little degen bag to start, but I just, it's just something I want to do. So yeah, I'll start small. There's no need to go all in all the time.
No, I mean, good luck, bro. I mean, just in the way you're thinking about it, I think you're thinking about it in the right way, and I think you're doing it right, and I think it may end up being a really good play. So we'll see how that plays out, and I'm rooting for you.
All right, thanks, man. Appreciate it.
Yeah, good luck, bro.
I'm gonna let you invite our next question asker onto the stage here, Messi.
All right,
yeah, you're good friends here.
All right, Gabriel. Let's see what you got, man. You ready to man up on stage? You ready to come up here and show us what you got?
Listen up, you red coiner teat suckler. Just kidding. What's up, guys? How you doing?
What's up, bro? What's up?
Well, welcome to the show. DeFi for beginners. What do you got, Gabe?
I love the advice.
Love your rant.
Great. Thank you. Good advice. I like the show. I like where you're coming from. I don't really have a question, but I just want to say I've been listening, I don't know, an hour or so. I like the thought processes, except for the red coin advice. That's obviously bad advice. But
you bridged when I told you to last night. We don't have to talk about it. We don't need to discuss it. But
yes, this is a safe place for red coiners. So.
No, true story. So if on my alt account, so I quit Twitter for a little bit in May, or not really quit, but I went to an alt account and I on that alt account, it's an account I had for a while. I made it private just because, when the market's tanking, people get really nasty. Twitter just becomes an awful place. And I just kind of wanted to get away from all of it, get my head right, get my head straight. But if you look in the bio of that account, it actually says Ethereum Maximalist. And I actually missed a lot of the Solana run earlier this year because of that Ethereum Maximalist kind of mindset. Why was I an Ethereum Maximalist? In retrospect, it was because I had grown up on Ethereum. I loved EVM. DeFi summer was incredible. I had so much fun, made new friends and connections. But when I came back from this account, and this account still says Ethereum Maximalist in the bio, I bridged over and I tried this Avalanche thing. And that's when I found out, and it just kind of clicked. I was shook by it, as a real Ethereum Maximalist, fuck everything but Ethereum. It kind of clicked to me that, hey, maybe I'm not like an Ethereum maximalist. I'm more of like an EVM maximalist. And that same EVM experience, which I think is fucking awesome, I could have, and it could be fast and cheap and all that kind of shit. But there's my little spiel on that. You got to bridge because $75 and above, they're going to give you free gas. It's just really frictionless. And even if you just bridge and fucking bridge back, it takes 30 seconds to bridge back. Just do it for the experience. It's cheap. It's worth it. It'll totally change the way you think. But for everybody listening, I followed, is it Gabriel, or how do you go by it?
Yeah.
Hold on, say that again. Gabriel. So I started following Gabriel a week ago, 2 weeks ago, and his content is effing hilarious, and I know he tries to look out for the little guys too. So you guys make sure to go follow him. I'll give you a shout out for having the courage, for having the stones to come up on here, on stage with me. That takes some balls, bro.
Stepping into the red coin circle. I appreciate you.
Right. That's right.
Oh, he's got an ETH connection.
Yeah, he's on that ETH, that dialogue, man.
You gotta send those guys up, bro. It's not.
You're breaking up really bad.
It's too good.
But guys, very very briefly, we are going to get token tax on here. I bet I can get them in here. We'll get them on here in the next couple of weeks. thank you guys for being here. We had a really, really good audience this whole time. Honestly, like we didn't cover nearly as much as I wanted to cover. I think the next, because we've already had this kind of intro and we'll have this recorded, it'll be a video. The next thing we do will just be pure Q&A in regards to DeFi, but we're going to do some more DeFi for Dummies episodes. I really, really apologize for not being able to get to everybody's questions. There really just is so much content. And then two, we'll give people an opportunity to, I want to hear what people are doing. Like I really appreciated that guy that came up and talked about, how he was farming. And we kind of got to work through that. So, if you guys are having these farming strategies you're willing to share, I'm really interested in hearing about them. So maybe you could drop those farming strategies below our tweet about this space on our Twitter. Maybe you can just, make sure nobody shits in your pool and don't share them with anybody. Or maybe you can wait to the next episode. But guys,
there will never be a time where I hear shits in your pool and don't laugh. The eye opener for me today was just a reminder that this stuff is not simple, but it's important, right? It's not easy, but it's valuable. And it's a conversation that I would like to continue having as long as I can to just learn from people that come up and ask questions. And then I'm thinking, oh, damn. Yeah, I forgot RandomMEMO was on Phantom. Should I be over there taking a look at that farm, especially now when prices are down and maybe there's an opportunity to get on the right side of impermanent loss and all that. So just to echo your sentiment, thank you guys for coming out. If we can't get token tax, I will do everything I can to find an accountant or somebody who can just come on and talk tax with us, particularly in North America, whether that's US or Canada, and see if we can just, get everybody on the same page with, getting on the right side of that, because you can't survive if you're on the wrong side of that. In my opinion, that's going to just come back and haunt you, or at least if it might, it's not worth risking. So final thoughts, Messi? I'll let you wrap it up, guys. Have a great day.
Yeah, I think I've already voiced my final thoughts. Just once again, thanks so much for everybody, coming. Really, really please try to take, if you take anything from this seriously, try to take that cash component discussion of your portfolio seriously. Trust me, I know it seems counterintuitive, but here's the right way to think about it. If you're, 30% cash, right, you still got 70% directional exposure. But when the market goes down, 30%, 40%, you're not going to be feeling the pain as much as everyone else. And if you're destined for your portfolio to go 50, 10x, whatever from that, you're still going to make a shit ton of money, okay? You just are. So just think about that. Consider that. And thank you guys so much for being here. Now, we've recorded this episode. I would imagine we'll have this episode up later on YouTube for your viewing pleasure, maybe sometime later today. Also, keep your eyes out. We will have this uploaded to Spotify as soon as we can. Maybe give us a day or two on that one. But thanks for coming, guys. And until next time, always make sure you play from a position of strength.
There we go. Let's do it.
Adios.
Cheers, guys.